Welcome back to Morning Trade Live. Time to get our minds into trading mode. I got Tom here with me in studio looking at some options on some interesting stories. We're going to talk some Alphabet, Google, a little Disney, probably some other stuff with Jason Ware joining us, CIO at Albion Financial Group. Jason, good to see you again. First, kind of give me your top-down take of your strategy going into next year.
Yeah, well, look, good to be with you as well. We're staying fully invested. We're actually a little bit more near-term cautious than I think, the average investment manager is, a little more cautious than Wall Street strategists. We think a mild recession is still likely the base case over the next 6 to 9 months. But nevertheless, we invest portfolios and we forecast with a heavy dose of humility. We could be wrong. So how we arrange the portfolios is we tilt a little more defensive when we think that when recession risks are elevated, and that's what we've done. So we're fully invested. We still have our long-term winners in the portfolio. That's going to be your mega cap tech. That's going to be your wide moat consumer growth stories, some financials, some healthcare, et cetera. But we have turned the dials into rallies a little more defensively by adding things like low volatility and a little bit of dividend stock. So still fully invested, but just a little cautious near term.
Okay. So are you in the camp that the big cap tech is the safest place to be, which is the way the market's pretty much traded it? Is that where you want to go if you've got doubts about the economy?
I think it certainly helps to own quality, right? Quality as a factor certainly outperforms to the downside. We know that when we see earnings revisions more steady and we see real earnings holding in better because they're a little less cyclical, those are areas that I think investors can overweight. So yes, I think Apple in the context of a recession probably does better than like a Deere or a Caterpillar, for example. So owning those stocks does make sense. Obviously, also beyond quality, these are names everybody has an association with Apple. We use iPhones, we use Microsoft, we use Google. So these are things that people are comfortable with and also still hold quite bullish long-term views on. So I think the mega cap is certainly one area that will do okay in the context of another leg lower, which again we think is probable. But then also we own an ETF. LVHD, which is a low volatility, high dividend ETF. It overweights real estate, it overweights utilities, it overweights consumer staples, some of those more classic defensive categories. So there are places you can go. Lockheed Martin is a lower beta, high quality stock that typically does better if we run into trouble in the market. So, lots of options out there for sure.
Okay, all right, nice. Like that. There's been a few interesting stories lately that I know you're watching that we've been talking about. Wanted to zoom in on for a sec this morning. One being Alphabet and a potential, now kind of a second stage of a lawsuit from Epic Games and the idea that they're a monopoly. They're having a little bit more trouble with this case than Apple did. How do you think it affects the company?
Yeah, great question. I don't think it affects the company much right now. So what we've seen is clearly that 15 to 30% that Google takes in their app store is at risk. However, we still need to see how the judge rules in January. And more importantly, Google has been very clear that they are going to appeal this. And that's going to kind of, throw some sand in the gears here for months or even years. So while this is certainly a headline win for Epic and a loss for Google, I think the reality is the impact to the business is over the short run going to be minor. And we'll see how this plays out over the long run. You mentioned Apple. They largely beat Epic in a similar type of suit. This stuff might end up in the Supreme Court. So probably still quite a ways away from seeing it hit Google's actual business. And I think that's why the stock has largely shrugged it off. Okay. All right.
Alphabet shares hanging out near these highs, pretty unchanged, Tom. To Jason's point here, the stock has got all these companies have a pretty good record of making their way through these allegations, claims, lawsuits. And if they lose, guess what? They got a lot of cash.
Right, and they've got appeal time, everything else.
Which is where they're at right now, because they already kind of lost the first stage.
Right, and they've got the other regulatory issues also. The Department of Justice is going after them also on a different front. Then you look at EU, UK also. But that being said, implied volatility is at or near 52-week lows in this name. So that's the first thing that sticks out to me. The VIX is at the 12 level, so there's not a lot of uncertainty out there. So if you want to take that directional bias, if you think the stock's going to continue to rally, but maybe not explode to the upside, I got a strategy here that takes advantage of that. Going out to the January 19th monthly cycle, so 37 days to expiration. You'll avoid that earnings event also with this one, where I'm just going to buy a simple bullish call vertical here because implied volatility is so low. It's going to cost me less money. So I looked at buying the 132.5 strike call. That's currently at the money, and then selling the 140 strike call, $7.50 wide bullish call vertical here. You're paying roughly about a $3 debit. It might be a little bit lower here, but if you pay $3 debit, you see that break even 135.50 over the next 5 weeks. It's about 2% above the current share price on this. And if you expect this thing to maybe grind higher, up another $6-7 up towards that 140, this pays off pretty nice with the risk reward setup. But this is a type of directional strategy. You offset some of the costs. Buying the 132.5 strike call, offset some of the cost by selling the 140 because you don't think maybe it's going to 150. This is the type of strategy where it's a little bit more conservative, but you're buying it at a cheaper price because IV is low.
All right. So right now, the options market's pretty calm with Alphabet.
Too calm.
Interesting. I have to say that it's pretty sideways as far as a few of the magnificent companies go, but close enough to the 52-week highs after it got blasted on earnings, came back. So it has been firming up since we sold off in that report. All right, let's shift out of the magnificent companies, Jason, and go to the doghouse where Disney's been living for a year or so. Last couple of months, things improving a bit on the margin. Market trying to give them a little longer end of the stick.
Well, I just think it got too cheap. When it went under 90, owning a franchise like Disney, your cradle to grave brand, incredible assets. Yes, they've been mismanaged a bit. Bob Chapek made some mistakes. He focused too much on subscribers, not enough on profits. But Iger's back in the fold. And Iger has a pretty solid, at least in our view, strategy to get Disney back from what he called the fix-it phase to the rebuilding the company for growth. And we like the strategy. They're investing a ton of money, I think $60 billion over the next decade into their experiences, which is really the flywheel for the Disney business. In addition to that, he's focusing on profitability, and we're actually moving in the right direction on profitability in streaming. I mean, we're probably going to be, went from negative 18% operating margins to flat here in a couple of quarters and probably be profitable at this time next year if we're having the same conversation. Meanwhile, they're cutting costs. They've actually overachieved on their cost rationalization. I think that's great. And then finally, they're starting to narrow the focus on content. Disney has been a content is king story for so long, but I think they overdid it. They overdid it on spend. They put out too much. They maybe extended themselves a little too far, stretched themselves too thin. And now Iger's going to rein that back in and focus on quality. So those are 4 things that we think get the stock back into the right camp. They're going to start paying a dividend again. That doesn't excite me a lot, but hey, if you want a dividend, there's a dividend too. Okay.
And I know you don't think that there's a big story or threat to any of their public image or their revenue from the ex-Elon Musk Twitter spat. I mean, it sounds like you're pretty bullish on Disney long term. When do you expect some of these things to come to fruition for the investor?
I think when Iger delivers on profitability and streaming, the stock has a fair amount of upside. So it might, slosh around here for the next 2 to 3 quarters. But I suspect next year at this time, the stock will be higher.
Okay. All right. Jason, thanks for the details. Good couple stories for us to do some trading with it. Tom, you got an approach here for Disney that is bullish with this idea.
Yeah, and Jason mentioned that that $90 price target seems to be maybe, bottoming cycle at this point. So if you think that's going to take place, I got a strategy here that takes advantage of getting, bullish, a little bit uber bullish, but using some puts to help finance a bullish call purchase. So went out to that same January cycle and I looked at a combo trade, bullish risk reversal on this one, where I'm going to buy the 95 strike calls in January and then to help finance that and basically pay for it, sell the 90 strike put in January. So you've got 37 days till expiration on this one. You're collecting a credit of about 50 cents, maybe a little bit higher. Stock has pulled back a little bit. But if you collect that credit of 50 cents, it takes your break even down to 89.50 to the downside. That's about 1 3/4% below the current share price. So you're giving yourself a little bit of a cushion. Now between 90 and 95, you basically just get to keep the credit that you collected. So you have that flattening cycle there. But anything above The 95 strike is where you start to get some real profitability in this type of trade. He mentioned Bob Iger trying to right the ship, cutting expenses. That might be a positive. And then you also have activist investors involved, trying to get involved here at this point. So it's an uber bullish trade, but you've got to be comfortable owning the shares if the stock does fall below that $90 strike into expiration over the next 5 weeks. But that being said, if you draw a line in the sand, hey, I'm comfortable owning the shares at 89.5. This is the type of strategy that works for you, collecting that credit on initiation, but definitely a bullish trade.
All right. Okay. Disney shares down a little bit today.
Yeah.
But a good month. And I think Jason argues the case pretty well.
Yeah.
As far as what I've heard. All right.